Here are four of Joseph Carlson's biggest wins, starting with Costco, which has returned for him an impressive 215%, followed by Apple, which has returned at 161%, then Microsoft with 137%, and then Texas Roadhouse with 80%. But what do all these companies have in common? Well, that they're what he refers to as free cash flow compounding machines. Today we'll be looking at Joseph Carlson, the master of compounding machines. One quote that I believe represents him and actually goes by what he stands for as an investor is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This defines him as a growth investor, not a value investor, and he is a self-made investor with a total invested sum of over 750,000. He has two main portfolios that are public, at least, one with 650,000 and then his story fund, which I believe is around $100,000. He's one of the biggest financial YouTube channels with over 300,000 subscribers. He's got one of the biggest Patreons in terms of the finance niche, and he's the creator of Qualtrim, which is an analytics webpage for screening and analyzing investments. To summarize his investing style, he's a long-term investor who gives a lot more importance to the company's ability to compound free cash flow rather than the stock's price. Here are 5 qualities that I think represent Joseph Carlson. The first one, as we've already stated, is his ability to focus and always be determined to follow growth investing. This is buying stocks that have the potential to grow their free cash flows faster than the market average and compounded over time. Then he is very focused on the long term. He disregards short-term fluctuations and he focuses on the fundamentals of the company. He has some criteria he follows in order to sell stocks, but these are, for example, only when the fundamentals change, only when he doesn't have enough cash and there is another better opportunity than this one, and only when I believe he doesn't like the company or it's becoming less predictable. So those are the 3 only case scenarios when he will sell a company. He is very good at sticking with his circle of competence. He only invests in industries and in companies he understands well. And if there's any company that he doesn't understand well, he puts a lot of effort in trying to understand their services, their offerings, and their products. And if he doesn't understand it, he just moves on to the next company. He's extremely focused on finding high quality businesses which have strong economic moats, and the most important thing for him, the predictability of the company's earnings. Knowing what they will do in the future, even if it's the short term. Of course, he doesn't have a crystal ball, so he doesn't know exactly what they will do, but he knows what the strategy more or less is, and he knows that, for example, next year Netflix will have around the same subscribers or even more than they have this year. And finally, the margin of safety. He's not an investor that puts a lot of focus on correctly determining the fair price of a company, but he does believe that for him to invest in a company, he would like the intrinsic value of a business to be higher than the market price. However, since he invests in quality businesses, he does not put a lot of focus on this, and he is fine with buying them at a premium for their quality. Here are 5 of the most important metrics he uses, or the ones at least I gathered from watching his videos for a long time. The first one, and the most important one for him, is the return on capital employed. This has to be higher than 15%, more or less. It has to be higher than the WACC, which is the cost of capital. And why is this? Well, this is because in order for a company to create value, the return on capital employed has to be higher than the cost of the capital that they are using for their operations. So this is why, as a rule of thumb, you could use a return on capital employed higher than 15%. And for this ratio, the higher you go, the better. Some companies which have an incredible return on capital employed are Visa and MasterCard, and these have been killing it in the stock market for a long time. He also focuses on earnings growth. I put 10%, but he doesn't actually give a number. He just wants to see predictable and stable earnings growth with his companies. Then the interest coverage ratio. This is very important because you want a company that will not have any future headwinds with their debt repayments. And in order to do this, if you put an interest coverage ratio threshold of around 10 times, you make sure that even if the company gets hit by a recession or by a decline in earnings that was unexpected, they will still be able to pay off their interest. Then a gross margin of 15% that has to be stable, and it's better if it's growing over time, and a free cash flow yield of around 2 to 3%. Just some quick notes: the return on capital employed should be among the highest in the industry, and it should be consistent year after year or even growing, same as the margin. And the free cash flow yield should be higher than the long-term expected inflation. Some important points to consider about his investing style is, first one, there is no hard math. There are no formulas, no spreadsheets, or even calculators that need to be used. Just very simple math, such as finding the free cash flow yield or discounting some cash flows into the future if you want to get very picky with valuation, which he doesn't. Number two, it is all about predictability. It should be simple to know how the company you're looking at will perform in the short term. Then you should also look at stock compensation, since very high share compensation will actually dilute the free cash flows. And this is actually why he has been very hesitant about buying Google, because they have a high share compensation, which is very bad for the free cash flows that us investors receive from the company. Number four, patience is key. Long-term investing is not a get-rich-quick scheme. You should have a mentality that this will take time and you will have to commit for a very long time. Number five, the company you're looking at should have pricing power and it should have the ability to raise prices over inflation. Some examples are Netflix, Google, Microsoft, MasterCard. Any company of that quality that you see in his portfolio very likely has high pricing power. And finally, other factors that are qualitative, such as moat, management, competitive position, etc. His method is first he does an initial screening of companies. Those companies which have a high return on capital employed, which have solid, consistent margins, and very good, stable earnings growth. He then develops the industry knowledge, and if he doesn't understand the industry or the offerings of the companies, he then discards them, unless he has actually been able to learn about them and develop a proper understanding. From here, he does some thorough research about their revenue sources, their offerings, the predictability of their earnings, any growth opportunities that the company has, and what is their likely strategy to follow in the long term. Then he focuses about competitors. He likes to see some industry insights. What market share does the company he's looking at have? What are the main competitors? What are their strategies? And what are the differentiation aspects of why the company he's looking at is better positioned than his competitors? Then some quick projections that are very qualitative, and he doesn't do any formulas. He just thinks, he looks at the analyst estimates and he believes if these are attainable for him or if these are not obtainable for him. Of course, in order to do this, the company should be fairly predictable. Then the valuation exercise is just very simple, as we stated, just focusing on the free cash flow yield and historic PE ratios. Some important information he believes is essential about effective investing is the first question: can the free cash flow growth and the margins keep being stable and keep growing? Second, that valuation is not too important, so don't focus on that. Put all of your effort into finding quality companies, not cheap companies. And then stability and predictability are key when investing and following this method. So the key to a great investment, according to Joseph Carlson, is first of all, the company should have a moat, which is defined as a strong competitive advantage. It should have consistent cash flows that are predictable and resilient, and it should have a high return on capital employed to make sure that it creates value for the investor. This will give you a great company, which will give you high returns, since it will very likely be a compounding machine. So thank you very much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic and Trading 212.